All right, what's good, everybody? Happy Monday. Welcome to the Doe Show. The new name we're going to be calling this live 1 o'clock show that we do every day. We'll try to keep them really short. If you want us to make them longer over time, let us know. But for now, we'll just keep it really simple. Got some new stuff going on the walls too there. I got nothing done this weekend around the house. I was just playing with all my stuff. So today, what we're going to talk about, first of all, I want to let you know, 5 o'clock, the brand new market update at 5 o'clock. I'm not going to announce the name just yet. You'll see it at 5 o'clock. The winner has been announced, or has been notified, actually, and the package is on the way. Thank you so much to everybody that took a shot at the naming of our 5 o'clock show. It was tough. It was really tough. I mean, we all sort of talked about it for a while, but just wanted to keep it simple. We had a really good name picked out. Thank you so much for participating. This Doe Show today, actually this week, our show lineup this week is just incredible. Everything from personal finances to some investing tips and tricks, of course. So we're not going to leave anything out now from the Doe Show. If it touches your money and I can help, if I feel like there's a way I can help, I'm going to do it here on the Doe Show. Today we're talking about diversifying your portfolio. It's a good Monday topic because it's kind of like the first day of school. You just kind of want to ease back into things. We don't want anything too complicated. And I really do, diversification talks maybe once every 6 months. They're not that exciting. They really don't grab a lot of attention, but they're really important. Now, at Jazz Wealth here, what we do is we take care of that for you. Our portfolios on our website, you can check out for sure, that have, they tell you how we build them, how we diversify and everything. So we take care of that for you. We're an investing service. Of course, we handle that for you, act as your financial advisor, and we do lots of classes and of course have the financial planning software. But diversification is, of course, really important, but some people really go nuts with it. And I just think, you can be diversified, but really it doesn't have to be by adding millions of products into your portfolio. So what is it? The very, very definition of diversification. If you've never heard it before, you're one of our younger people, here's the most simple answer I can give you. If you have a store in Florida that sells coats, that is not very diversified, right? You're going to sell coats only a very short time of year. So the performance of your store is going to be mostly flat, except for the 5 days a year where Florida gets obscenely cold, well, for Floridians, and then you'll sell a few coats, then right back to nothing again. If you sell coats and bathing suits in Florida, that's a mix, right? Now you're diversified. You're not going to sell a lot of coats all the time, but when you're not selling coats, you're going to sell bathing suits. So that's what diversifying really is. And it's the same in investing. We want to build a portfolio, maybe just a big basket, right? And inside of it, we want investments that perform on their own during different times in the market, but as a whole, begin to fill up our basket, begin to grow for us, really is the thing. So if in the basket, I'll use, what's a popular one? Have you guys heard of Intel? I'm going to get better at this, I promise. Intel, the symbol is INTC, and AMD. If those were the only two investments you had in your portfolio, well, you must be feeling pretty strong on the chip makers, but the problem is, let's say chip sales in China suffer a 50% decline, you're going to lose on your entire portfolio. So that's not diversified. So a great example would be to have these two and then maybe Coke, right? Just a silly example, or Verizon, right? If you're picking stocks, okay, we're starting to diversify a little bit here, but stay with me. We're diversifying not only on the stock, but also on strategy. That's a big one for me. We always diversify by strategy, not necessarily product. Of course, we're going to have a nice mix of products, but with exchange traded funds, you kind of are already diversified by buying into one or two other things. So, okay, so that's something we want to think about. We'll touch on these a little bit later here, but the idea is you want to know how things work together. Of course, AMD and Intel, easy example, you get it. What happens if you invested in Brazil? Do you know how Brazil works, right? So think about this. Brazil right now is getting clobbered, right? If you happen to look at pricing, their markets, whoa, right? They're getting clobbered. But if Brazil turns around and commodity prices are already going up, then emerging markets, right? Emerging markets on their own, they'll do really well. So you betting on Brazil really is taking a shot at a few other things happening. You want to know how these things work. If Brazil's suffering, commodity prices are dropping, emerging markets are going to do poorly. So you want to really know how that works. Now maybe that one was a little out there. I might have went a little too far. Let's do a real simple one here. So if the US economy, if growth, right? We're in the middle of earnings season. If growth comes in slower than normal, do you know what investments would do well? Want to take a shot at that? You want to think about it? Want to say that to your dog sitting next to you? If growth in the US economy slows down, then bonds start doing well, right? So stocks might suffer a little bit, bonds might do well. Let's get rid of that one. That one's done. Okay? So think of that. That's why they had that old saying, stocks and bonds, 60% to 40% or something like that. Because when growth slows, those bonds should help support you a little bit. When growth is strong, the stocks will help support you a little bit. Now, you might say like, all right, okay, let me see. To diversify, can't I just have a boat ton of products in there? Can't I just put a bunch of ETFs in there and diversify? Yeah, right? Let's think about if you had this ETF that was focused on the banks, you had this ETF that was focused on tech or something, maybe some gold, oil, you got it, right? You go, well, aren't I diversified? This has 100 products, this one may have 1,000, this one's got 500 or whatever it may be. Aren't I diversified? And I'm a stickler for speed. If you pick this as your portfolio, you better be able to tell me how fast it's going to move, okay? That, to me, is the whole key to this whole thing here. So if you've got this portfolio with all this stuff, mix and match whatever you want, the S&P 500, or some index, is going to move along at some pace. How fast is your portfolio going to move relative to the S&P 500? Do you know? Right? You should know. You have to know this. So whatever basket you put together, speed is the ultimate thing. Now you go, well, Dustin, I'll just buy the S&P 500. I'll just buy the index. Everybody says go buy the index. Do the index fund investing. The people that tell you to buy index funds don't buy index funds. Does Warren Buffett own index funds? Nope. Does Donald Trump own index funds? Nope. Tim Cook, right? Anybody famous? Go turn on the financial news right now, this very moment. They do a lunchtime talk. There's like 6 people sitting at a desk. Does any one of them that is currently giving advice to people to buy index funds, do they own index funds? No, you can look it up, right? It's all public knowledge. So why do the wealthy not have index funds? Well, part of it is they sort of don't think that you can understand how this all works, right? The easiest thing for anybody to do is just buy an index fund. That's like saying the easiest thing to do when your air condition breaks is to call the local people on TV. There's a lawyer in town that he must do everything because every time he does a commercial, it's a different thing. Malpractice, motorcycle accident, starting a business, getting rid of a business, all these things. He does all this stuff. So you think, I'll just hire him, right? I'll go do it. So you think of an index fund as something that's already diversified and something that's going to cost you less. Those products, those are meant for the people that just want to pay bottom dollar for everything, even though it comes at the expense of them making money in the future. So let's say you go, I'm going to buy the S&P 500 index fund. I'm diversified, Dustin. I got 500 different companies. What if that index falls? We are in a point right now where you've got the S&P 500, the Dow, the NASDAQ, right? And don't forget, everybody always forgets the Russell 2000, right? These don't all move together. Right now, if you said, I'm going to buy the Dow, it's really simple. I understand it. I can look on TV and see how it did for the day. I'm going to buy an index fund. It's not going to cost me anything. You were really sort of sucking right now. You're underperforming everybody. If you said, I'm going to buy the S&P 500, most common index fund that people use to diversify, you are underperforming right now. You're not doing very well. If you said, I'm going to buy the NASDAQ, okay, you're doing pretty good. All-time highs, right? And I think right now, still at this point, if you would have bought the Russell 2000 index, you're beating everything, right? That's the best. But who picks the Russell 2000? Some of you probably never even heard of that until I just wrote it on the screen. So index fund investing, always ask the people that tell you to buy index funds, which ones do they own? Which ones are they buying? And it's not a bad thing, right? They don't own index funds. We don't offer index funds here at Jazz Wealth because we know we can do better for you. It may be that better means performance. It may mean that better means defining your risk to the exact point that it needs to be. So careful with those index funds, because everybody's always like, I want to do the index fund because it's cheap. That's the answer I get all the time. Dustin, it's the cheapest product. I want to do the index fund. What if that means that you miss out in the long run? We're putting together a study right now. We're going to do it for our customers first. We'll see how it goes. We're putting together a study to see if you bought an index fund, how much did you save relative to missing out on being in a growth product or being in something that beats the market, beats the index. How much did you miss, even net of fees? So we're going to talk about that. Anyways, all right, a couple quick things and then we're going to roll on. Because we got a busy day today. We got our first market update at 5 o'clock and got all kinds of stuff to do. All right, first, diversification, asset classes. This is like stocks 101 here, right? So asset classes, you've got stocks, bonds, and now real estate. Oh. Okay, different asset classes. When people say diversify, most commonly they're saying diversify by asset class. That's about as detailed as they'll go for you. They'll say go ahead and do like 80% stocks, 15% bonds, and if you can, stick in a little real estate in there. That's what they do for that one. So know when someone says diversify by asset class, they're talking about mainly these. This is basically what everybody's talking about, okay? So that's the first way you can diversify. The second way is by geography, right? You can look at a map. Nowadays, you can invest in China, click of a button. You can invest in Brazil if you want to take your shot, click of a button. Canada, Mexico, you can invest in all these places really, really quickly these days, but it's important that you diversify. And a good example would be Canada versus China, right? You want to know how those things work, or Canada versus Mexico, Brazil versus China. Where are these things at? How do they move relative to what your goal is, right? So diversifying across geography. Now, can you also do this with individual stocks, by the way? Could you say, I have no idea, Dustin, how to invest in Canada or China. I don't even know how that works. Could I pick a stock that has exposure to China or Brazil or something like that? Could I pick a commodity stock that's based in Brazil? Certainly. A great example would be Micron Technologies. This is a chip maker. The symbol is MU. Over 50%, and now I believe over 60%, but I'm going to just go 50% so nobody gives me a hard time. 50% of their net sales come from China. So if you have some reason you need to diversify in China or you want to push some of that off, there you go. You got Micron. You got a stock like Intel. So we'll go back to that just to wrap it all up here. Intel is more even across all the different countries. Not perfect, but it's more like 10% China, 10% Taiwan, 20% United States, things like that. So you get a chance to diversify by stock over all of it, okay? Whether you want to invest in the individual country or you just like researching stocks and you want to find some stocks that are based in another country or get a lot of sales from their other country. Okay, and the last thing, of course, is speed. You better be able to tell me, Dustin, I have the following 10 stocks in my Robinhood account or whatever it is you have, and they are moving 1.1 times faster than whatever the index you want to track. Dustin, I have the following stocks and ETFs in my portfolio. Don't email me, by the way. But I have the following in my portfolio, and it is moving at 0.8 times the speed of the S&P 500. Better be able to tell me that, right? Because things are fine right now. The markets are, fine. They're not great, but they're fine. When the markets start to fall and your investments start to fall rather quickly, you're going to think, oh my God, I must be invested wrong. Sell, 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 sell. Well, did you need to sell? Maybe you were only moving at half the speed of the market, and it's not such a big deal that things fell a little bit. If you don't know that, and you're invested twice the speed of the market because you bought, Apple 1,000 times and Bitcoin or whatever it is you bought, and the markets fall a little and your portfolio falls a lot, you're going to panic. It's going to cost you money. So you better be able to tell me how fast your portfolio is moving. Put a graph together, do the math, figure it out to where things are moving together. That's what we do at Jazz Wealth. We make sure that you're moving at the right speed. Being diversified all around the world and having these portfolios filled with diversified products, that's the easy part. Knowing how fast things are going to move. I talk to my clients and I say, how fast do you want to move? Are you close to retirement? If so, we have that conversation of, well, if the markets are moving this fast, right now things are up, then we need to move this fast. That way, if things go the other way, right, you see the difference there. Markets go this way, you're going to be like that. It's the easiest way to explain it. It makes me sound rather silly and undereducated, uneducated, but it's really simple. If we can take something complex and boil it down to speed and diversification, then of course, we're good to go with that. All right, so we're going to wrap it up there. I really appreciate you guys watching live show today. Just incredible what we've got coming up here. You have 100% of your portfolio invested in target date retirement funds. Do you think that's okay? If it's a 401k, it could be your only choice. I find that a lot, that 401ks are more and more starting to offer that as their only choice. I would look at the other options that are getting the same goal that you're looking for and just see if by chance you could save a little bit money by allocating it yourself. I would say about 50% of the time, I do 401k reviews for our customers every night. That's my favorite thing to do at night. And I would say doing many dozens a night, I think it's about 50% of the time I've come across a cheaper way to allocate the exact same growth. Everything's going to look good, but by buying some of those funds yourself. So something to take a look at. But anyways, thanks for the question, and we'll see you guys at 5 o'clock. Tune in for the new show. It is coming up, 5 o'clock. We'll see you then.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.